Hey, good morning, everybody. It is Mike, and this is Saturday Morning Multifamily Unplugged. I want to welcome you to the show. Hey, if you're new here and this is your first time, boy, you're in for a surprise this morning. So one thing I always talk to my listeners about first time as we get started is intentionality. What are you being intentional about? Let me ask you, for instance, how'd you start your day today? Do you have daily disciplines that you start your day with? Maybe it's prayer, maybe it's meditation, maybe it's you think about what you're grateful for. How about exercise? But whatever those daily disciplines are, how did that start your day for you? And as you go out and you start to talk about intentionality, what are you being intentional about today? How are you building your business? What steps are you taking education wise? What steps are you taking to execute on activity? You know, we can learn things, we can get educated, but until we take that step, until we put them into action, they really don't give us enough power. You see, education is really only the potential for power. What really is power is when we execute, when we take that action and we move forward to go buy a deal, find a deal, raise capital, whatever we're doing. And we're going to talk about a lot of that today. I'm glad that you're here. As I said, if you're here for the first time, please go to YouTube and subscribe to our channel there. If you follow us on social media, please like this, like our content, follow us there. We're always coming up with relevant content, whether it's on Instagram or LinkedIn, wherever you get your social media fix. And this is every Saturday morning at 10 a.m. We are live streaming, and that's 10 a.m. Central. We are live streaming to Facebook, LinkedIn, and YouTube. So I'm glad that you're here today. And I know that our guest is going to provide a lot of information. I'm happy about our guest today, Scott Crone. He's a Chicago area guy and has a company here in the northwest suburbs of Chicago. We're going to talk a lot about self-storage. We're going to talk about leadership. We're going to talk about raising capital, maybe even how we structure deals and the fundamentals behind that. So before we get started, though, I want to remind you that today's event is sponsored by the GOB Network. And we have an event coming up in Chicago in July 13th and 14th. GOB Network is a non-for-profit. What they do is they give back to financial literacy in this country. You know, it's a big thing. A lot of people don't know that they can passively invest, or they don't know that there's alternatives to the stock market or other type of investments. So this is a great platform. In July 13th and 14th at the O'Hare Westin, there will be a 2-day event. It's going to be over 600 people at the event. There's tickets that are left for the event. If you want to go, you can go to the website, log on, use the coupon code Morawski, my last name, and you'll get a substantial discount. So I look forward to seeing everybody there for some networking. And there's a big goal at this event this year for us to do 40 deals in the room. And so either come to the event with a deal or come to the event prepared to get on a team and be part of that sponsorship team. So either way, whether you're brand new or you're a seasoned investor, there's going to be plenty of opportunity for you. All right, let me bring our guest in right now. Hey, Scott, welcome to the show this morning.
Thanks for having me. I appreciate the opportunity.
Man, you know, here's what I know. You and I have been trying to get together for a while, and we've had a couple of conversations, and it finally took a third party to put us together. And I'm grateful for Matt this morning. That's for sure.
Well, I'm sorry I was busy, so I'm glad we could connect.
Yeah, I know. I finally got you pinned down. I appreciate that. So, you know, sometimes in our life, it's hard to find an hour just to carve out to just have a conversation with somebody, you know?
Absolutely.
So listen, Scott, what I always like to do at the beginning of my show is kick it off with one question. And I always ask my guests, I say, hey, in one word, what best describes you personally and professionally?
That's an interesting question. I've actually done a lot of personal work on this. And there's a program called the Enneagram, which breaks down people into different categories. And according to that, it would be loyal would be one, but I would also add resilient. So those are the two words that I would use, would be loyal and resilient.
Okay, awesome. So I want to dig into resilient a little bit, because in my bio, I say I have a resilience for bouncing back. And I think you know a little bit about my story, but what makes you resilient?
Well, I think if you're a business owner, you're constantly having to overcome objections and rejection, if you will. So every time that you don't get something, you might put a proposal out 10 times and you might get 1 or 2 accepted. But you have to have that resilience to keep coming back and keep believing in yourself and what you're doing, and believing that there's an overall bigger purpose.
Boy, that's interesting that you bring it into that perspective. Um, I talk about looking at deals today, and we just did a 40 unit down in Tampa. But to get that one deal awarded to us, I underwrote 80 deals. I wrote 7 LOIs to get one accepted. So, at what point do people give up, or what point do people keep going? I guess it's a matter of how bad you want something, right? Is what you're going to do to go get it.
Absolutely, and believing in that, there is a reason why you're doing what you're doing. So
Yeah.
if you don't have that underlying principle behind you, it's certainly it's hard to keep the motivation.
Yeah, absolutely. All right. So, what I really like to do is let the listeners know a little bit about who you are, your background, what you're currently doing, how you got there.
Well, my background is I have a master's in architecture, and I came back from undergraduate. I had a total of 3 weeks off between my undergraduate and my graduate work, and began pursuing a master's of architecture at Illinois Institute of Technology. And I was fortunate enough to get connected with a professor who owned a real estate development, architecture, and contracting firm. And his specialty was multifamily. And so as his TA, he would assign the class to work on actual projects that he was working on. And so out of everybody in the class, he picked my project as the one to focus on and refine and continue to develop. So when I was his quote unquote TA, I had to work in his office. And then I would go and work for him, on the project in school. And then I would go home and do homework on the project as well. So basically I was working from 7 in the morning until midnight on this project. It was right here in Deerfield, not too far from where you are.
Yeah.
It was a 400 unit, $100 million project. And so that was my introduction into real estate and real estate investing. And I worked for him for 6 years between being in school and out of school. And then at the ripe old age of 28, I thought I was stupid enough to think that I knew enough to start my own company, and began a development, design build firm. And from there, we were initially on single family. Then we got into multifamily mixed use. We've done a handful of churches. And then obviously the crash came in 08, 09. And that's when I began transitioning to multifamily. But as you know, everybody and their sister was investing in multifamily, and the cap rates were compressing, and it got really hard to find deals. And that's when I was first introduced to self-storage. And in 2013, we developed a self-storage facility just south of O'Hare, and it was flipped. And from there, I eventually sold off my multifamily. We've been focusing on self-storage.
Okay, great. And so when you say you flipped that self-storage, did you sell it to a big company or just another operator?
It was a small REIT. I wouldn't say they were a big company. They were in the, they were in the Midwest, and they were looking to expand into the Chicago market.
So for some people that don't know a lot about self-storage or know anything about self-storage, what are the fundamentals like? How closely related to the multifamily space are they?
They're very similar. I mean, a lot of times when people say to me, I totally understand multifamily, but I just don't get self-storage. I'm like, what don't you get? It's apartments without toilets. It's like the most simplistic version. I'm renting a box, right? And what's an apartment? It's a more elaborate box, right? It's a more extensive box. It has more amenities. It has more features. But we're all, in essence, just renting amount of square footage. Yeah. But the difference is that it's a retail business, and it's a very predictable retail business based upon demographics. And so when we were developing multifamily, it was sort of the field of dreams approach: build it and see if they will come. And with self-storage, we know what will happen based upon the demographics of the community.
What's interesting is I've always liked self-storage from this standpoint. If people don't pay their rent, you can lock the door, you can try and collect your rent. If they don't pay their rent, you can sell their stuff. It always seemed a little bit easier from that standpoint than it is in the multifamily space, where you actually have people living there and those toilets that you have to deal with versus just a place where people put their stuff. You know, you have thoughts around that at all, or?
I mean, that's absolutely one of the biggest things. I mean, that's why operationally, multifamily, and I'm sure you would concur, the operating expenses are between 50 and 55% of your operating income. In self-storage, it's between 25 and 35%. And a lot of that has to do with the fact that we don't have to do those things. We don't have the overhead or the legal and the eviction processes that are in multifamily, especially here in Illinois, where it is so onerous against the owner. I mean, there's, Illinois is, I think, one of the worst states when it comes to owners' rights versus tenants' rights. Everyone is concerned about the tenants, but obviously the person who owns the building's got to pay the mortgage and pay the bills as well.
So Scott, do you build everything new that you do, or do you buy existing like mom and pop deals and operate those?
Yes, and more. So,
Okay.
I mean, we just recently bought a facility in Lansing, Michigan, which was an existing facility, and we have no plans on expanding it. What we saw was the rents were 30% below market, and so we came in and day one, we raised the rents 30%. And then we're implemented everything to be automated. So all the payments, everything. The previous owner, when we asked for his due diligence, literally took a Xerox copy of his notepad and he hand wrote every single transaction. And he was texting people with his, not even a smartphone, a dumb phone. He had a flip phone and he would text people. And so that's how, simplistic he was running his operations. And we've come in and automated the whole system. And so that's the easiest thing that we've done. The next is that we buy existing buildings and convert them into self-storage. So we're buying underperforming commercial buildings and then converting them into self-storage. And then the last thing is, excuse me, the last thing is we're building new facilities.
Okay. And what's a better type of facility for you? Just a climate controlled facility, or one that's not climate controlled?
We're building climate controlled, especially the existing buildings. We're converting those into climate controlled, and then the new ones we're building climate controlled.
Okay, interesting. And do you find that more people demographically like the climate controlled ones, or will rent the climate controlled more so than they will just an outdoor storage?
And I think yes, because we're in some cold areas, and so people prefer that to drive into a dry, safe, and secure building, as opposed to driving. I mean, they're urban settings, and so people can literally drive into our buildings. The garage door comes down. They can open up their trunk, their car doors, unload, take their stuff to their unit, close their car, and then drive out.
Yeah.
And so being climate controlled there is certainly important. And when we're talking about people's goods and possessions like their furniture, it's a lot better for it to be in climate control, because then you don't have the expansion and contraction. The facility that we're doing in Louisville is because of humidity. Humidity is the biggest factor in terms of what we need to control there.
Let's see. So you've talked about Michigan, you've talked about Chicago, you've talked about Louisville, Kentucky. Do you have a specific market that you like best, and how do you choose the markets in the self-storage business?
Well, we see that the East Coast, Florida, Texas, the West Coast are when I say the West Coast, it's California, are predominantly very saturated with self-storage. So the national average is 7 square feet of lockers per capita. And in Florida, they're building some facilities which are like 13. They're building new facilities when the existing supply and demand is 13 square feet of lockers. So it's way oversaturated. So we're preferring the flyover states, and that's what we're looking. And so when we identify a location, we pull the reports on that specific location. And so we will get the demographics of like a 3 or 5 mile radius. And that's our market, 3 to 5 miles.
So when I'm in the multifamily space and I'm underwriting a deal, one of the first things I want to do is I want to look at the set of what I like to call traps, right? The population growth, the job growth, the household income, crime, schools, all of those types of metrics. How many of those are transferable into the self-storage business, or do you have a different set of metrics that you look at market-wise in the self-storage business?
We look at all of those. We look at medium income as well because that dictates what size of units, and then we look at what the saturation level is. So that's the next one. And so we will get a statistic like it's 4.5 square feet of lockers per capita, or 7.4. And so we look at a building and the market is 9, we won't even bother with all the other stuff. For us, those are the first is saturation, and then all the other things are secondary due diligence, if you will. I mean, we're going on Tuesday to look at a building in Cleveland that someone owns, and they want to convert it into self-storage, and they've asked us to come consult or build it for them. We haven't finalized what that's going to be, and before we even did it, we looked at what the demographics were, and we saw that there was demand for self-storage in that location.
So are you doing a lot of retrofit?
Predominantly.
Really?
Yeah.
And
so we've done retrofits in one in Milwaukee. We've done 3 here in Illinois. We've done Toledo, Dayton, and Louisville. And then we're looking at Kentucky as well. I mean, Cleveland as well.
so is there a product, a current building product, like a big box, call it an Old Cub Foods or a Kmart or something of that nature that works better than others? Because you can't even, warehouse space today, right, is hard to find. So if you're trying to retrofit warehouse space, are there old retail spots that make sense for this, or office? What are the best products to find to retrofit for self-storage today?
What you described are great for it. It's usually whether or not the zoning will allow it. So a lot of times the local municipality will want to maintain that as retail, and they don't really view self-storage as retail. But we've converted like the Lincoln Log Factory. We've converted a battery warehouse and office, and a key warehouse and office. Excuse me. We've also did the first fireproof building in Milwaukee, which was actually a Harley Davidson dealership at one time. It's an 8-story building. So we've done single-story buildings. We've done up to 8-story buildings. The building that we did in Dayton was completely empty. It had been empty for 40 years, and we came in and there's a tremendous amount of development around our building, and it's like 3 blocks from the Dayton baseball team. So I'd like to give a shout out to the Dayton baseball team as they embark on their summer campaign here. We like to support our neighbors.
Okay.
Usually I have a baseball hat, but I don't have the Dayton one at this point in time. But
Is that a AAA team, Scott?
I think they're single A, I believe.
Okay.
I'm not sure if they're AAA. I believe they're single A.
Okay.
But we're like 3 blocks from the stadium, and so we're right in the heart of downtown there, and the building's been vacant, and we bought the building, and it was zoned for it, and so we could come in there and as of right and convert it into self-storage.
So that's interesting. That building you said was vacant for 40 years. What was it?
Originally, it was like a warehouse.
Okay. And, do you find that there's some deterioration that's happened over that period of time that you had to go in and re-engineer or reconstruct?
Oh, we had to do a tremendous amount. So the reason why we bought the building is we bought it for like $12 a square foot. So I can't build that structure for $12 a square foot.
Right.
And so even with the money that we had to put into it, which was quite a substantial amount of money, it was still cheaper than building new, like 40% cheaper. So it was all new roof, excuse me, all new mechanical, new elevators, all HVAC, electrical, plumbing was all brand new. A lot of the windows were blown out, so we had to put in new windows, and we closed up a lot of fenestrations to make the building more energy efficient. But the structure was good, and so we didn't have to worry too much about the structure.
So in multifamily, we call that value add, right?
Absolutely.
Same thing in self-storage.
Definitely. And the whole reason why it wasn't converted into multifamily was, and I'm sure you can appreciate this, that the structure didn't accommodate itself for parking, underground parking. And so the bays did not line up. I mean, the first thing that I was taught in when I was getting my master's was you design the building around parking. So we'd have 18-foot wide bays, so you'd get 2 cars in there, and then 18 feet deep for the first column bay, and then 24 for the driving lane, and then another 18. So our building was 60 feet. So that way you could have parking on both sides and have a driving aisle. And these bays were like 12 and a half. So you could only get like 1 parking space in there. And then, you'd have all this wasted space, which then cut down the number of parking spaces, which then cut down the number of units that you could have based upon, like a 2-bedroom has to have 1.5 parking spaces, or a 1-bedroom has to have 1. So if you're doing like a 6-story building and you want to put in, call it like 50 units, you're going to have like 100 parking spaces.
Yeah.
And they couldn't do that.
Okay. So obviously it was a natural kind of retrofit for that then.
Absolutely.
Yeah, good. How about, and I want to just go back to office space for a minute. Is there a possibility with office buildings to do self-storage, or is that kind of and maybe it depends on the structure, right? I mean, if you got a 20-story office building, it might not make sense, but maybe with a 2 or 3-story office building where you've got some square footage, does it make sense in something like that?
In really intense urban environments like Chicago, they have 20 and 30-story self-storage facilities. So it's not out of the question. We haven't seen that level of demand in the markets where we are, and so that's why we haven't gone that far.
Your client demographics, what do those tend to look like? Do you look at those demographics at all from a standpoint that they're just overloaded in their house, they're moving, they're do you see trends in certain markets of things that are happening that it makes more sense to do self-storage in that area?
Absolutely. To answer your question, I'd say 57% of our tenants are women, and between commercial and residential, I'd say 50% are commercial, like businesses, and 50% are what we call residential, or personal tenants, non-business. So we always look at the demographics, because the higher the medium income, the larger they're wanting to buy units. Like we had one in north of the city, in the suburbs, and we couldn't rent the 10 by 10s. So we took out the wall and in between the 2 units and made them 10 by 20s, and they rented up immediately because people wanted really big units. And more economically challenged environments, they're willing to pay more for a smaller unit. So they might be in an apartment, they might need an extra 25 or 50 or 75 square feet, and that's all they need. And so they're willing to pay a higher price per square foot than a larger one. They don't need a 200 square foot unit.
Do you, in your self-storage facilities, is it only self-storage, or do you have some office space and conference rooms and things like that are also rentable spaces that people use?
Our Louisville building is the first one that has 2 different uses. The building was really consisted of 4 buildings. So there's the original building and 3 additions. And so we divided half the building into what we call flex warehouse space, and then half will be self-storage. And we did that specifically because of the fact that if we ever wanted to sell it, we had the ability of condominiumize the building and selling half of it as self-storage and half of it as flex warehouse space.
Interesting. I never thought about flex warehouse. I always thought that self-storage is a good match for these facilities, and I know there's a couple of operators out there that have office and conference room space where shared, even some shared space like WeWorks and that.
It could be, and that's what this could be used. The zoning just allows us more flexibility by saying flex warehouse. So if someone wants to use it as an office space, they could, or if they want to use it as warehouse, they could. I mean, we have a company in there that makes rappelling equipment. And so their office and their operations are there where they're assembling this equipment and then they're shipping it out. And then we have, people that repair furniture and craftsmen who, make furniture and stuff in the building. So it's just a wide range of tenants. But we could have a speakeasy being in Louisville where we have a little bar in the basement where, a coffee bar. That's one of the things that we envision for it.
Well, that's kind of neat. I bet there's some history in that building.
Oh yeah, it was part of it was used to store stuff for the Kentucky Derby.
Oh, wow. Interesting. Did you find anything?
No, it was all emptied by the time we got it.
I always like some of these buildings where you go in and you do some real demo and you get in the wall and you find some stuff that, old pop bottles or a bottle with a note in it, or, we found some pretty creative stuff inside walls sometimes. It's kind of interesting.
When we were building a condominium in Winnetka, we demolished some homes in there, and the insulation was newspapers, and it was like from the turn of the 18th century that they had newspapers in the wall. So, here we're pulling out these old newspapers and reading them.
Wow. And was anything going on then that's any different than today?
I think it's just more expensive problems, the same problems, but just cost more now.
just another zero. That's all right. So, how about outdoor? Yeah. Yeah, right. How about outdoor storage?
A new facility that we're working on in Michigan right now will have boat and RV storage as well. And so we will have 4 tiers. We will have open, just if they just want to park something out on a lot, out on a gravel lot. And then we have covered, enclosed, and then we have self-storage as well.
What do you find that outdoor stuff is as productive as indoor or less productive?
Inherently, by definition, is less productive because of the circulation space. So the big advantage of multifamily is that when we were designing, we would try to get things down to like 10% circulation. We were really efficient if we had 10% circulation. So you'd walk in, have a corridor, double loaded, and you were renting or selling 90% of the building, as opposed to, self-storage, we're like 70% because we have to have so many more corridors. So
yeah.
if a corridor is 5 feet, but the units are only 10 feet deep, and then every 20 feet you have to have a corridor, you have a lot more circulation. The problem with outdoor storage is that you're storing RVs and boats and cars and stuff like that, and those turning radiuses is like anywhere from 24 to 40 feet. And so you're taking up a lot more in circulation just so that people can back into their spaces.
Especially an RV, right?
A 40-foot RV, right?
Yeah. Hey, so when you put your deals together, are you guys just doing them on your own, your group, or are you going out and syndicating them, raising private capital? Are you offering opportunities where people can invest passively in your deals, or are you just strictly doing active things for your own group?
Well, ever since my first project when I was 28, we've had equity investors alongside of us. So the first one we had 3, and after I returned their money to them, they said, "Do it again and don't tell anybody." And I was like, I'm like, that means I better start telling people if I'm they want to keep it this little cloister.
I love that. Do it again and don't tell anybody.
Yeah, that was my father, my uncle, my grandfather. And I'm like, come on.
True family and friends.
Exactly. And so we have investors now that come alongside and participate with us. And, when people call us up and, we do 3 things. We partner with people, people can hire us, or we can facilitate and they can be passive income. So we really structure the opportunity or the deal, if you will, based upon each person's criteria, what they're trying to accomplish.
So can you talk a little bit about your deal structure? Is it, how do you structure a syndication deal? Is it a 70-30, just like we would do on the multifamily side? Are your investors getting a preferred return? What types of IRRs can they see?
It's really deal dependent. Like the asset that we bought is entirely different than development. I mean, there's completely different expectations. Like one's existing cash flow, and the other one we have to build it and lease it up, and so there's inherently greater risk, and so there should be a greater reward. So we structure everyone based upon the actual deal. So there's just not one template. We want to make sure that we're hitting certain milestones and expectations, and it varies between if it's development versus an existing facility.
So can you talk about just maybe a past deal you've done where you bought a mom and pop deal and re-engineered it, and what that structure looked like and how your investors got blessed as a result of that?
For that one, we did do a preferred return because of the fact that we would have cash flow, but we told them that the preferred return won't kick in until the first year, because we figured that when we're going to come in and raise rents, we will lose occupancy. And then as people, get used to that rent increase, and we were still below the market when we raised them. Fighting a little bit of an allergy here.
Sorry.
When we raised them, it was still below the market rate. So we felt that we would maintain our existing tenants, but we're assuming that there's going to be a drop. So the first year we said we're not going to pay out the preferred return because we're expecting transition. And then once we have that, then we'll do the preferred return, and we will expect returns in the teens. If we're doing development, then we expect it higher because of the fact that you have to wait. We're going to buy the property, build it, lease it up, and then cash flow, and that takes 3 to 5 years.
So I know you've done some multifamily as well as self-storage now. Do you think that finding investors in the self-storage space is easier than multifamily, or is it about the same? Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets. Just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
Well, I think, multifamily has been like the golden child, if you will, for the real estate community since 08, 09. And the cap rates are incredibly compressed. And I sold out and I thought we were at the peak, and that was 4 years ago. So, I didn't time it perfectly, but I got out when I thought was a good time. And I would say that as much as multifamily is the golden child, self-storage is the ugly stepchild. And no offense to, stepchildren, but I'm looking at the Cinderella version here where, everyone poo-poos and belittles the self-storage because it's not the sexy asset class. But if you think about it, we're doing like 600 units for, our cost is less than $6 million. And if we did 400 units and we sold it for $100 million, I mean, it's just a fraction. So we have a lot less exposure. We have a lot less risk. And so I can get a lot more diversity in rental units comparatively. But, sometimes it's, as you might experience, like, raising $50 million is actually easier than raising $50,000. I think the smaller the dollar amount, it's actually harder to raise the money. If you're trying to raise $50,000 with people, they'll say, well, why don't you just do it yourself? Don't you have $50,000, right? So if it's a larger amount, then you can get bigger institutions, you can get, pension funds, you can get different entities that are backing you. And so I think it's actually easier to raise a larger amount of money. So
do you raise in a fund or per deal?
They're all per deal. We're not a REIT. We don't have a one specific fund.
Got it. So I've heard a lot of talk about the difference between multifamily and self-storage in cap rates. Can you talk to that a little bit?
We have the different asset classes, just like multifamily, but they're not like a Class C in multifamily is like a bad neighborhood, and a Class A isn't a great neighborhood, right? Or a Class D is a bad neighborhood. In ours, it describes more of the product type. So Class C is your first generation drive up facility, smaller, maybe operated by a mom and pop type facility. Class B would be more suburban, larger, around 300 or 400 units. It may be climate controlled, but it's still drive up. And Class A is urban, drive in, fully climate controlled. And we equate them to like penny stocks. So Class C would be a penny stock, a Class B would be a blue chip stock, and a Class A would be a growth stock. And so when we're looking at each of those things, that's how we determine what the risk allocation is towards it. So the one we bought in Michigan is a great Class B asset. It's not in a big urban market. It's more rural. It's like 300 units. It's in great condition, and it has steady rents. And so it's like a blue chip performing asset.
Interesting. How about financing? What's financing like in this space?
It's actually that has developed a lot in the last 10 years. I mean, we've seen a lot more. Like originally, like Wintrust told us like no self storage. They do not have self storage in their portfolio.
Wow.
And so this is back in like 13, so almost 10 years ago. They wouldn't even consider it. And you can get SBA financing for it. You can get commercial bank lending on it, and you can also get like a private fund type of funding as well. So there's a lot of options now. And CMB financing, once it's stabilized for bigger assets, we can go to the CMB market and get great financing for it.
It's interesting. A bank like Wintrust would say that they had no interest in self-storage. I mean, if the fundamentals are there and it's thrown off cash, you said something early on. You said this is a business, and that's why I like buying workforce housing, because I can walk away from closing. I'm collecting a coupon right away because it's a business I bought. Right now, I'm going to go re-engineer the business, whether that's some construction capital improvements or whether that becomes re-engineering the business entity of it. So I find it kind of interesting that the bank might say, hey, we're not doing this.
It's all level of experience and comfort, right? If they haven't done it, it's easier to say no than to say yes, which goes back to our very first question. How many no's are you going to get before you get a yes?
Yeah.
Right. Sure. So it all ties back to your first question. Any
owner financing in this arena?
A lot in terms of repositions. So we're part of a mastermind of other self-storage operators.
Okay.
And a lot of them will structure existing facilities when they're buying existing facilities. And the owner's just too old, doesn't want to do it anymore, but he wants to clip a coupon, or they want to clip a coupon. And so they'll do owner financing. But it's hard to stack multiple layers of within your capital stack with owner financing, because traditional banks won't want it. So if you have a traditional bank as your primary debt, it's hard to have owner financing, below them or a part of the capital stack.
Well, it's interesting. All right, so we're almost to the end, and I know that we said we were going to talk a little bit about leadership and capital stack. And how about a couple of tips on leadership? Who's your favorite leader? What's important to you about that?
Well, a year ago, I entered a program, a 2.5-year program on leadership, and a lot of it begins with yourself. And so, we've been looking at different elements of how leaders, the lack of investment in oneself causes a lot of problems within leadership. So the more that you have a good foundation in terms of what your source of, for me, the source of my faith or in the direction, that bedrock will then provide better, sustainability over a long period of time. And so, that is what we're looking at. And like the first one is, are you dangerously tired? And I don't think a lot of people in society today recognize just how overwhelmingly tired they are, and they're just constantly on a treadmill. And so, the next one was retreat in solitude. And so you began the conversation with like, what are your morning practices, and how do you recharge and how do you refocus? And a lot of that are the disciplines that we've been learning over this 2.5-year program. And the Enneagram that I reference as well as part of that. And so, my morning begins at 5:30 in the morning, where I'm paddle boarding on Lake Michigan 8 months of the year. And that's my silence and solitude for, 30 or 40 minutes out on the lake, where I have no distractions. It's just me and, and God out on the lake. I have to be quiet and listen, right? And so for me, that's where it begins.
Wow, that's pretty cool. You wear a wetsuit, I'm sure.
No, because you have a lot more motivation not to fall in.
Oh, that's funny. Hey, let's wind this down. I like to ask 3 bonus questions. I know you do a little bit of traveling, so maybe we keep these bonus questions really focused on Chicago right now, though, because this event is coming up in July. People will be coming to Chicago, and they might want to see a good tourist attraction. What do you think's a good tourist attraction in the area if somebody's here all weekend?
Well, that time, I mean, Ravinia is fantastic. I think like ABBA's playing, and usually there's other big bands. John Fogerty I think is playing around that time in July.
Okay.
So if you have the ability to get up to Ravinia, it's one of my favorite places during the summer.
Yeah.
Personally, I spend last weekend or 2 weekends ago was like Christmas for me because they opened up the beach again. So I'm down by the lake. That's for me. If Chicago without the lake is Kansas City. It's like, no offense to Kansas City, but the lake is where you need to be during the summer. So if you can get to Navy Pier, if you can get to North Beach, any of those things along the waterfront, is that to me is the best part of Chicago.
Absolutely. I would agree 100%. Somebody said to me the other day, what's your favorite thing about living in the city? I said, my only favorite thing about living in the city is a bike ride on the lakefront on the weekend. So
yeah,
always a lot of fun. Hey, how about the best restaurant?
Ooh, well, it certainly depends on your budget. I mean, Chicago Cut is fun. Beautiful location around on the lake. I mean, not on the lake, on the river. Right downtown on LaSalle and Wacker. Absolutely gorgeous view. There's Maple and Ash, which is par none. If you're not that high end, if you're looking down next level, there's plenty of local places that you can get in the city. And that's what I always do whenever I go to a new city is I ask people like, hey, what's your favorite local spot? And so, out near Rosemont, if someone's not here, then you got to go Chicago pizza. And there's plenty of Chicago pizzas out there. And I will say I'm a little biased towards Malnati's. They're friends. I've known them since, I was in high school. And so like every Friday night I was part of a youth group and they would bring pizzas. And so, every Friday night we had Malnati's pizza. So that's what I grew up on.
I love Lou Malnati's butter crust deep dish dipped in Thousand Island dressing. Spoken like a true Chicagoan, right?
No grabber there, right?
Yeah. I'll meet you. How about the best book you've ever read?
Well, I mean, that's a tough one. There's just so many good ones. I'm going to say some that I've read recently. What really helped our business is The Road Back to You by Ian Morgan Cron, and it might be Cron. I've been told I might be pronouncing it wrong, but it's a general description of the Enneagram, and it describes the 9 characteristics. These 4th century monks came up with this stuff. It was absolutely amazing, but it breaks down personalities and how we communicate and how we listen, and where we go in times of stress and where we go in times of positive things. And so by identifying everybody in our office, we can communicate better as a whole, because if there's something that normally triggers someone, then I can avoid saying those things that might cause them to trigger, so that I can be more effective as a leader in communicating with them. And then if they're saying something to me that's triggering, I can say, it's just triggering me. So stop putting value in that and just address the problem. Does that make sense?
Yeah, absolutely.
I also really love Henry Nouwen. I think he's a great person, just an incredibly intelligent man back in the day. And Scott McKnight's another great author that I've enjoyed recently.
Great stuff. Well, Scott, thanks for being here today. I appreciate it. Man, you're a wealth of knowledge, much more than I ever anticipated. So again, hats off to Matt. And
you had low expectations.
Hey, you're too humble. Listen, how do people get a hold of you when they want to reach out and connect with you, find out a little bit more about what you're doing or the self-storage space?
Well, Mike, thanks for asking that question. So a great way is as you see tickering across the bottom here, is at info@codamg.com. And Mike, for your listeners, if they reference this show, then we will send them two things. We will send them one, a feasibility study of our property that we did in Dayton, and so they can see why we went into that market. We hire these third-party consultants to come in and assess the 3-mile radius or the 5-mile radius. And they talk about self-storage as a whole across the country, but then also very specifically about that market. So it's a wealth of knowledge for the industry as a whole. And then we'll also give them a self-storage analyzer, so they can plug in if they get some basic numbers, and then they can compare it to multifamily and see if it's good or not, good deal or bad deal. So they can just plug in the assumptions and we'll do all the calculations.
Well, Scott, I'd like to get that done.
I'm happy to send it to you.
I'll reference the show.
Okay.
Thanks for being here. I look forward to connecting. I'm going to move you to the back room. If you would just sit there for a minute, and we'll spend a couple minutes together. I'm going to say goodbye.
Absolutely.
Thanks.
Thank you.
Hey, everybody. That was Scott Crone from CODA in Deerfield, Illinois, talking about self-storage and some leadership thoughts. I just want to thank you for being here this week. Great show. Scott was a wealth of knowledge. If you are looking at self-storage as a asset class, you may want to reach out to him and give him a call. Whether you are looking to get involved as an active investor or a passive investor, either side. Remember, GOB Network is hosting a live conference here in Chicago, July 13th and 14th. I'll be speaking at that event. I'm looking forward to that and looking forward to seeing you there. Remember, we're here every Saturday. If you're new to the show, make sure you tell somebody else about it. We'd love to have them here. We're always bringing great guests like Scott. We're bringing relevant content, market information, how we source deals and look at deals, and everything that you need to be successful in your real estate investing, multifamily, self-storage business. Look forward to seeing everybody soon. Have a great week.